Long before the glint of the first coin, humanity sought ways to store and trade value. Our journey into cross-border investment begins not with money, but with the very materials that would one day form it. In ancient settlements, people traded in raw metals. Lumps of copper, bars of silver, and rings of gold were the earliest forms of wealth. These metals were valued for their rarity, their durability, and their beauty. They could be melted, shaped, and carried across great distances. A merchant traveling from Mesopotamia to Egypt might carry ingots of tin, a metal prized for making bronze. This was a simple, yet profound act of international investment. The metal held its value, regardless of the local language or ruler. This reliance on raw metal was a system built on universal trust. A piece of gold was gold, whether it was mined in the hills of Anatolia or traded in the markets of the Indus Valley. Its worth was inherent. There was no need for a king's stamp to guarantee its value, only a set of scales to measure its weight. This created a stable, if cumbersome, foundation for international trade. Merchants could confidently exchange goods for metals, knowing that this tangible wealth would be accepted in distant lands. This was wealth in its purest, most elemental form, a silent language of commerce understood by all. It was the first step toward a global financial system. Of course, this early system had its challenges. Weighing and testing the purity of metal for every transaction was slow and inefficient. It required expertise and honest scales, which were not always available. This created an opportunity for a revolutionary innovation, the coin. By stamping a piece of metal with a specific weight and a mark of authority, a ruler could guarantee its value. This simple act transformed trade. A foreign merchant no longer needed to carry scales and touchstones. They could simply trust the symbol on the coin, a symbol that represented a promise from a distant kingdom. It was a promise that this small metal disc held a specific and reliable amount of wealth. This transition from raw metal to stamped coins was a pivotal moment in human history. The first coins, emerging from Lydia in modern-day Turkey around 600 BC, were made of electrum, a natural alloy of gold and silver. They were small, portable, and carried the seal of a king. Suddenly, wealth was not just a lump of metal. It was a standardized unit of account, guaranteed by a powerful state. This innovation did not erase the intrinsic value of the metal, but it added a layer of trust and efficiency. Foreign traders could now accept these Lydian coins with confidence, knowing they could be used or exchanged elsewhere. The journey of the international investment coin had truly begun. As the idea of coinage spread from Lydia, it was embraced by the great empires of the ancient world. The Greeks, with their network of city-states and colonies scattered across the Mediterranean, were masters of this new technology. Each city or polis minted its own coins, often with stunning artistry. The Athenian owl, a silver tetradrachm bearing the image of the goddess Athena and her sacred owl, became one of the first truly international currencies. Its high silver content and consistent weight made it trusted far beyond the borders of Athens. Merchants from Egypt to the Black Sea hoarded these coins, not just for trade, but as a reliable store of wealth. They were a stable asset in a volatile world. The Persian Empire, a vast domain stretching from India to Greece, also understood the power of a unified currency. King Darius the Great introduced the gold daric and the silver siglos. These coins were minted to a strict standard, and their circulation facilitated trade across the empire's immense territory. A soldier serving on the frontier in Egypt could be paid in darics, confident that his wages would be accepted by a merchant in Persia. For investors and traders, these coins were more than just money. They were a symbol of the empire's stability and economic power. Holding Persian gold was like holding a share in the prosperity of the largest empire the world had yet seen. Then came Rome. The Roman Empire perfected the use of coinage as a tool of statecraft and economic control. The silver denarius, and later the gold aureus, became the backbone of the Mediterranean economy for centuries. From the misty shores of Britain to the deserts of Syria, Roman coins were everywhere. They paid soldiers, funded massive construction projects, and enabled a level of trade never seen before. For an individual living in a conquered province, Roman coins were a tangible link to the empire's power. Hoarding them was a logical investment. They were a liquid asset, easily convertible to goods and services anywhere within Rome's vast domain, and their metal content provided a fundamental store of value. The spread of these imperial coins created a remarkable level of economic integration. A merchant in Gaul could save a stash of Roman denarii, knowing they represented a universally accepted form of wealth. These coins were not just local currency, they were international assets. The symbols they carried, the Athenian owl, the Persian king, the Roman emperor, became global brands of trust and stability. Investing in these foreign coins was a way to participate in the economic success of these powerful empires. It was a strategy for preserving wealth that transcended local borders and connected individuals to a much larger economic world. The collapse of the Western Roman Empire in the 5th century AD plunged Europe into a period of profound instability. Central authority vanished. Long-distance trade routes fractured. The sophisticated system of Roman coinage, once a symbol of unity and stability, disintegrated. New local rulers, from Germanic kings to feudal lords, began minting their own coins. However, these new currencies were often of poor quality and inconsistent weight. Their value was uncertain, and they were trusted only in the small territories where they were issued. This created a crisis of confidence. People yearned for a reliable way to protect their savings. In this chaotic environment, the memory of stable, high-quality coins lingered. People began to favor older, more reliable currencies over the debased local coinage. Roman gold solidi, even centuries after the empire's fall, were still hoarded as a safe store of value. But more importantly, people looked beyond their immediate borders for trustworthy money. The gold coins of the Byzantine Empire, the successor to Rome in the East, became highly sought after. The Byzantine solidus, later known as the bezant, maintained its weight and purity for centuries. It became the international currency of the early Middle Ages, a beacon of stability in a fragmented world. A Frankish nobleman or a Viking trader would prefer a single Byzantine bezant over a pile of dubious local silver coins. This preference for foreign coins was a rational investment decision. It was a flight to quality. When your local ruler could melt down coins, mix them with cheaper metals, and reissue them at the same face value, your savings could evaporate overnight. A foreign coin, especially one from a large and stable empire like Byzantium or the growing Islamic caliphates, was a much safer bet. The Islamic gold dinar and silver dirham, minted to exacting standards as dictated by religious law, also circulated widely. They were trusted from Spain to Central Asia. Finding these coins in a hoard in Scandinavia is a testament to their role as a preferred international asset. This period demonstrates a timeless principle of investment. In times of uncertainty, capital flows towards safety and trust. The physical coin became the ultimate refuge. It was portable, anonymous, and its value was based on its precious metal content, which was universally recognized. People were not investing in a foreign government so much as they were investing in the tangible security of gold and silver, guaranteed by distinct stable power. The act of choosing the Byzantine or Islamic coin for a local one was a vote of no confidence in local authority and a personal strategy for wealth preservation that spanned cultures and continents. As the Middle Ages gave way to an era of renewed exploration and trade, the world became more connected. Great trade routes, both overland like the Silk Road and maritime routes across the Indian Ocean, acted like arteries, pumping goods and money across continents. Along these routes, coins travelled just as silks and spices did. A Venetian merchant trading in Alexandria might be paid in Egyptian dinars, which he would then use to buy goods in the Levant. These coins became a crucial medium for international exchange, and savvy merchants learned to value them not just for transactions, but as investments in their own right. The most successful trading cities like Venice and Genoa began to mint their own high-quality coins. The Venetian gold ducat, first minted in 1284, was of such reliable purity that it became a dominant trade coin for centuries. It was accepted from England to India. A merchant could accumulate ducats from various transactions, knowing they formed a stable and liquid asset. This was a sophisticated form of cross-border investment. By holding a portfolio of trusted currencies, ducats, florins from Florence, and Islamic dinars, a merchant could mitigate risk and operate across different economic zones. These coins were the lifeblood of a burgeoning global economy. The discovery of the Americas in the late 15th century would revolutionize this system on a scale previously unimaginable. The Spanish Empire gained control of vast silver mines in places like Potosí in Bolivia and Zacatecas in Mexico. They began to mint enormous quantities of silver coins, most famously the Real de Ocho, or piece of 8. This large, heavy silver coin, also known as the Spanish dollar, was of a consistent weight and fineness. Its quality was so trusted that it became the world's first truly global currency. It was the standard coin of trade not just in the Spanish Empire, but across North America, Europe, and Asia. The Spanish silver dollar was more than just money. It was the ultimate international investment asset of its time. A Chinese tea merchant would gladly accept Spanish dollars from a European trader, knowing they were pure silver and could be used locally or melted down. In the British colonies of North America, the Spanish dollar was the primary coin in circulation for decades, and it even formed the basis for the new United States dollar. For over 300 years, the piece of 8 was the backbone of global commerce. Hoarding these coins was the safest investment one could make, a bet on the enduring value of silver and the vast economic network it supported. The colonial era, really solidified the role of foreign coins as a primary means of storing and moving wealth. In the sprawling empires of Britain, France, and the Netherlands, there was this complex mix of currencies circulating everywhere. For example, a colonial official in India might be paid in British pounds, but would conduct local business using silver rupees. Or, say, a plantation owner in the Caribbean might price his sugar in Spanish dollars, pay his workers with French coins, and then bank his profits in Dutch guilders. This constant flow of different currencies made merchants and administrators quite adept at currency exchange and arbitrage. They became, in effect, international coin investors simply out of necessity. Hoarding was a common practice back then. In remote outposts, far from established banks, a chest of solid foreign coins was honestly the safest form of wealth. It was secure against the risks of local instability, crop failure, or even piracy. These hoards often contained a fascinating variety of coins from around the world: Spanish silver, Portuguese gold, Dutch ducats, and British guineas. Each coin represented a small piece of a distant economy, a tangible asset protected from local troubles. For colonists, merchants, and even pirates, a diverse portfolio of foreign coins was, the most practical form of financial security. It was portable, universally valuable, and held its worth regardless of the flag flying overhead. But alongside this practical use, a new motivation for acquiring foreign coins began to emerge: collecting. The Age of Enlightenment brought with it a passion for history, science, and classification. Wealthy individuals, scholars, and aristocrats started assembling cabinets of curiosities, which often included ancient and foreign coins. This was, in fact, the birth of numismatics as a serious hobby. Coins were no longer seen just as money or bullion, but as historical artifacts. They became windows into the past, telling stories of forgotten kings, fallen empires, and distant cultures. This added a new layer of value to a coin, one based on its rarity, condition, and historical significance. This shift from hoarding for survival to collecting for intellectual pleasure really marked a turning point. The market for foreign coins began to split. On one hand, you had investors who sought the safety of precious metal content in coins like the Spanish dollar. On the other, you had collectors who would pay a high premium for a rare Roman aureus or a perfectly preserved Greek tetradrachm. This new demand from collectors meant that the value of a foreign coin could far exceed its metallic worth. The act of investing in foreign coins became more complex, requiring not only an understanding of markets and metals, but also a knowledge of history and art. The 19th century brought, a whole new era of order to the world of international finance. The gold standard. Led by Great Britain, many of the world's major economies agreed to fix the value of their currencies to a specific amount of gold. This created a system of stable exchange rates and fostered immense confidence in international trade and investment. A British gold sovereign, a French 20-franc Napoleon, or an American $10 eagle all contained a known quantity of gold. They were, in essence, interchangeable. An investor could hold any of these coins with the confidence that their value was guaranteed and internationally recognized. This system made investing in foreign gold coins safer and more predictable than ever before. The coins of major industrial nations became premier assets. The British sovereign, in particular, circulated across the globe as a symbol of the British Empire's economic might. It was trusted currency from Canada to Australia, from Hong Kong to South Africa. For an individual, holding sovereigns was like holding gold itself, but in a convenient, recognizable, and easily traded form. It was a simple and effective way to protect wealth, and many people built their savings by accumulating these reliable gold coins from various nations. The rise of the gold standard also coincided with the golden age of coin collecting. As the middle class grew, more people had the time and resources to pursue the hobby. Numismatic societies were formed, detailed catalogues were published, and auctions became major events. The market for rare and historical coins boomed. Investors began to look for coins that had both intrinsic metallic value and a numismatic premium. A rare date of a US gold coin or a limited mintage German mark could be worth many times its weight in gold. This required a new level of expertise, blending the skills of an investor with the knowledge of a historian. However, this period of stability was not without its anxieties. The very system that made gold coins so reliable also highlighted the weakness of paper money. Banknotes were merely promises to pay in gold. During times of financial panic or political instability, people would rush to exchange their paper notes for real coins. This run on the bank showed that, when trust faltered, people instinctively returned to the tangible security of precious metal. Even in this sophisticated financial age, the ancient wisdom of holding physical, portable wealth in the form of foreign gold coins remained a powerful instinct for investors around the world. The 20th century, with its 2 world wars, the Great Depression, and the end of the gold standard, really shattered the financial stability of the previous era. In times of crisis, faith in paper money and even in national governments simply collapsed. People once again turned to foreign coins as a discreet and portable safe haven. As armies marched across Europe, families fleeing persecution or conflict would, quite literally, stitch gold coins. British sovereigns, Swiss francs, or American eagles into the linings of their coats. These small metal discs were a lifeline. They were anonymous, universally accepted, and could be used to bribe a guard, buy food, or book passage to a safer land. The coin reaffirmed its ancient role as the ultimate crisis asset. After World War II, as the world rebuilt, governments made it easier for ordinary people to invest in precious metals. In 1967, South Africa introduced the Krugerrand. This was the first modern bullion coin, designed specifically for investment. Its value was tied directly to the price of its 1 troy ounce of gold content. The Krugerrand was a brilliant innovation. It was an affordable, accessible, and easily tradable way for anyone to own gold. Its success inspired other countries to issue their own bullion coins, such as the Canadian maple leaf, the American eagle, the Chinese panda, and the Austrian philharmonic. Suddenly, investing in foreign coins was no longer the preserve of the wealthy or the well-traveled. The arrival of the internet completely transformed the landscape for coin investors. Online auction sites and dealer websites created a global marketplace that was open 24/7. A collector in Japan could now bid on a rare coin from a seller in Germany with just a few clicks. This digital revolution provided unprecedented access to information and inventory. Investors could instantly compare prices, research a coin's history, and view high-resolution images from their own homes. The barriers to entry fell away. The once niche world of international numismatics became a global, transparent, and highly active market, accessible to anyone with an internet connection. Today, the smart investor in foreign coins looks for a combination of factors. They consider the coin's bullion value, the underlying worth of its gold, silver, or platinum content. They also assess its numismatic value, which is determined by its rarity, historical importance, condition, and aesthetic appeal. Modern bullion coins offer a straightforward way to invest in precious metals, while classic and ancient coins offer the potential for higher returns based on their collectible status. The modern investor can build a diverse global portfolio of tangible assets, blending the security of bullion with the historical allure of numismatics, all from their computer screen. So, why do people today, in our age of digital finance and complex derivatives, still choose to invest in small metal discs from other countries? The reasons are as timeless as the coins themselves. First and foremost is the desire for a safe haven. Foreign coins, particularly those made of gold or silver, are seen as a hedge against inflation and economic turmoil. When paper currencies lose value or stock markets crash, precious metals often hold or increase their worth. A portfolio that includes tangible assets like foreign bullion coins can provide a crucial layer of stability and peace of mind in an uncertain world. Beyond simple security, foreign coins offer diversification. They represent a unique asset class, disconnected from the volatility of traditional stocks and bonds. An investor might hold American stocks, European bonds, and a collection of Swiss gold Vranelli, Austrian philharmonics, and historical British sovereigns. This spreads risk across different economies and asset types. Furthermore, for the numismatist, there is the added dimension of history and artistry. Owning a 2,000-year-old Roman coin or a beautifully designed coin from the French Third Republic is an investment in a tangible piece of human culture. It is an asset that provides not only financial potential, but also intellectual and aesthetic satisfaction. However, this journey is not without its perils. The modern investor must be vigilant against a host of risks. The market is plagued by increasingly sophisticated counterfeits, which can fool even experienced eyes. Verifying a coin's authenticity through professional grading services is essential. Price volatility is another factor. The values of both precious metals and collectible coins can fluctuate wildly. Secure storage is also a critical concern, as a physical collection is vulnerable to theft. Investors must decide between a safe at home, a bank's safe deposit box, or a specialized third-party vault, each with its own costs and benefits. Finally, the investor must navigate a web of legal and tax regulations. Buying and selling coins across international borders can involve customs duties, taxes, and restrictions on the movement of so-called cultural property. A lack of knowledge can lead to costly mistakes. Despite these challenges, the allure of the foreign coin endures. For millennia, these objects have served as a store of value, a medium of exchange, and a symbol of trust. They are a unique intersection of wealth, history, and art. A portable legacy that you can hold in the palm of your hand. In a world of fleeting digital data, the solid, tangible reality of a coin continues to offer a powerful sense of security.